I do believe it's going to remain a headwind. I mean, if you look at the cruise liners right now, first of all, yes, people are going back on cruises, but the fact of the matter is we're seeing breakouts on those cruise ships. People are being forced to quarantine. You're having ships that aren't able to dock. All of these things are going to make other people not want to cruise. And then when you look at the technicals, you have quite a bit of overhead resistance. While the cruise liners have traded higher, they've traded directly into key resistance levels that for me look like great places to come in and short these stocks. Sure, they will rally on any positive news, but in the long term, they're just not looking good right now.
Let me add this coda. I don't know if we've put up the disclosure yet. You said you don't personally own any cruise liners at all, but your husband does because he's been trying to convince you that the stocks are going to do better. So if we see on the disclosures that you own it, it's him, not you. So I love the marital split over this.
Yes, we're having a little bit of a competition, and he's also working on trying to get me back on the cruise liners. And one of the cruise liners, I can't remember, I think it's Caribbean. If you own 100 shares, you get onboard credits. So you see, they actually are convincing millennials to buy their shares because of this ridiculous idea.
Wow. Okay, Chris, are you among those who are buying up, the cruise lines for some perks on board?
Well, it's good to see you again, Kelly. I have to say I'm more with Danielle's husband than with Danielle today. I think that for the long term, they seem well positioned to me. I would certainly look through the credit card data that Bank of America looked at today, and I would certainly also look through the Omicron problems, which are serious, but I think relatively short-lived. So the one proviso I would have, and this is important for your viewers, which is be careful because they look like they're down by 70, 80% from pre-pandemic stock levels, but they've issued so much new stock and so much debt that the actual enterprise values of these companies are much higher than you might think. So in other words, they're not quite the value you think, but I still think they'd be a nice place to invest over the next year.
Bob, where do you fall?
Well, look, these companies are entirely trading on what's going to happen in the second half of the year. So look at, I don't know, Carnival, for example. They used to do $16 to $20 billion in revenues. They cratered in 2020 and 2021. It went down to $5 billion or something like that. The analysts are expecting them to do close to $20 billion this year. It's all in the second half of the year. They're going to go back to 2018 all of a sudden. You know what the PE is? There isn't any because they're going to lose money for a third year in a row. They're trading on 2023 estimates about 12 times forward earnings. You know what it used to trade at? 12 times forward earnings. My point is the price is way down, but the earnings are way down, even the expectations for 2023. So I don't assign ratings on any of this, but look what the market's telling you. It's telling you right now that they're not expecting a lot of upside.